Let's back up for a minute and explain, why this is a big deal for some investors. Half of all trading now versus 0% in 1997 related to high frequency. What is it and why should people care?
Well, the issue is how these traders use technology to, as Schneiderman says, gain an edge, which is milliseconds over trades of, anybody else that's trading on the street. And that essentially what many people think levels or equals an unlevel playing field. Now, the other issue, of course, is that he's looking at his dark pools. No, those are very untransparent trading venues, and we don't know what goes on inside of those. And the fact that there is a complete lack of transparency worries not just Schneiderman in his office, but a lot of other players in the market. So dark pools where basically one firm can say to another, hey, I want to trade this big block of stuff. And by the way, it has a pretty big effect on pricing because the volume is strong enough. So it's happening sort of behind the scenes, not being reported in a fully transparent way.
Well, and you may remember them from 2011. Or 2010, or 2009, back when they were a big deal. Why do we care again, right? The SEC already looked into this. It was a front-page story years ago.
I'll tell you why we care, Matt Miller.
Was
okay, hang on one second. I will tell you exactly why we care. Because Americans want to know that it's a fair system. And if some machine has a tiny advantage over you, that somehow, in essence, feels un-American, feels sort of non-capitalist at its foundation. Is there anything that can be done, John Coffey, to restore people's trust right now in the markets? And is it related to high-frequency trading?
Well, you could do a number of things that would level the playing field. The question is, who makes the rules? We have a confrontation developing here between the New York Attorney General and the SEC. The particular practices that the New York Attorney General is focused on, which are known as co-location and special data feeds, effectively sell order priority to the high-frequency traders. They both get the right to put their trades in ahead of the rest of the market, and they get the first information. Everyone else learns market prices from Reuters and Bloomberg, which are the source to the world. But if you pay enough to the stock exchanges, they will tell you at the same time as they tell Reuters and Bloomberg, and that gives you that 1,000 seconds of advantage that unlevels the playing field.
Well, the other thing you could do to level the playing field is when you do your research into a stock or a strategy and you make your purchase, you could actually invest that money and hold it. Because high-frequency trading only gives someone an advantage over someone else who's doing basically slightly less high-frequency trading. It's only against day traders. If you're a buy-and-hold investor, like most Americans are, you will not be affected in any way, shape, or form by high-frequency traders.
Issues like the flash crash. Keri, I mean, your average American out there that's investing in the markets, let's face it, they've felt like after 2008, after the flash crash, after reports like this about high-frequency trading, that they don't really have the edge that, say, the professionals have. Is that true? Is that fair for them to think that?
Assuming they're trading in and out of stocks, right, over minutes. Because you don't need an edge if you're buying a stock and holding it.
I don't care if you're trading in and out or you're holding it forever. You don't like the idea that some other guy is going to have a better shot at something because he's either paying someone to do it or there's a computer that's computing this algorithm so quickly that you've got no shot against them.
I think the whole point of the investigation of what the AG is doing right now is to figure out where those unfair issues lie and whether or not they're legal or illegal or simply unethical. And I think that's the whole point of them digging into this.
John Coffey, you're the lawyer.
I gotta tell
Are they legal or illegal?
There really is a confrontation brewing here because we can't have two different regulators making the structural rules for trading. And we've got the SEC, which has tolerated all this for years, rightly or wrongly. And now we have the New York Attorney General using its special statute, the Martin Act, to say suddenly this is unfair and deceptive. But we can't have inconsistent rules governing both the New York Stock Exchange and Nasdaq.
So is the SEC behind the curve?
The SEC knows about this and has never stepped in to in any way stop it. The New York Attorney General says it's unfair, but I think sooner or later...
But they've never liked it. I mean, dark pools, they've always been somewhat concerned. It's been on their radar.
Yeah, so the SEC has looked into this. Remember, that was in 2011, right?
Right, but the SEC is a civil regulatory agency, and Eric Schneiderman is the top law enforcer in the state of New York. So he has a different view on how these practices might be unfair.
That's the problem.
As John
New York
Coffey
Stock
said,
Exchange can't live with two inconsistent regulators saying structure the market this way or don't structure it this way.
Doesn't federal law typically prevail?
Well, I think basically, traditionally, we said the SEC is the principal market regulator. We've allowed anti-fraud regulation by the New York Attorney General, but he's now moving into the structure of the market, and that's a much bigger invasion of the SEC's traditional jurisdiction.
I'll say it's amazing. You know, we've seen this huge run-up in the market, but you look at the volumes and the participation rate amongst average Americans, and it's nothing like what it was. And I think it's somewhat tinged by all this concern that, you know, maybe it's not really a fair system. Anyway, Keri, great job breaking the news. John Coffey, always a pleasure, Professor.
And it's a fascinating story, Keri.
Thank you.
Glad you broke it.